Will housing crash by 30%? Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, and I want to have a look at this article written by David Llewellyn-Smith for news.com.au, asking how high can interest rates go before they crash house prices, with some expecting house prices to crash by 30%. Now, before we go through this, let's jump over to this other screen. Now, 15 hours ago, I put up this poll. What would you do if housing fell 30%? And I put three options: sell, buy, or hold. Now, we've had 1,400 votes, and you can find this on the community tab, or I'll put a link to it in the pinned comment of this video, so you can vote, and we'll go through the comments tomorrow. But at the moment, only 5% of you would sell, 53% would buy, and 42% would hold. I think that comes down to, I imagine the people buying would also be holding what they have and probably be accumulating more property. So check out and leave your comments there and your opinions, and we'll go through that probably later today or tomorrow. Okay, so there's options for that. Now let's jump back here and let's see this take on it. Now, it's the moment every mortgage payer has been dreading. What impact could rising rates have on house prices? So this is an analysis. Now, David is, I'd say, quite concerned from a macro perspective. If you read a lot of the stuff that he puts out there, he's I'd say bearish about a lot of things and warning about potential downside of rate rises and a lot of what's happening in the world at the moment. So, how high will interest rates go is not a question that Australians have had to deal with for a decade. And let's bring up this chart here to show the cash rate. And you can see, I remember a couple of years ago just reading about interest rates. 3% rates in these documents from the RBA were considered emergency rates. 3% for the cash rate. We're at 0.1. We've got nowhere to go. Our current Reserve Bank governor has promised, can we trust him, that we won't go negative, but they also said they wouldn't raise rates until 2024. So you tell me, everyone, if you trust him. I'm sure most of us don't. That's why at least the viewers of my channel seem to have all locked in their mortgages or prepared for it. But you hear other people who are surprised. They're surprised that the Reserve Bank are considering raising rates before their promised deadline. I guess people have to learn the hard way to not trust them. Makes you wonder what other modeling is incorrect around the place. But anyway, it's been a ceaseless ride of lower interest rates since the RBA last hiked in 2011, all the way down from 4.75% to 0.25%. But now financial markets are forecasting a relatively steep sequence of interest rate rises to a cash rate above 1% before the year end. Okay, above 1%. I mean, we're at 0.1% now, and I'll bring up the chart just again, but above 1%, that's let's look back, 95, yeah, that was a pretty steep rise. Look at that, close to 18%. You reckon we could see that, guys? So, even a reluctant RBA has acknowledged that the cash rate may move much sooner than it has recently expected. Remember, no cash rate rises until 2024. So we all went and fixed our mortgages because none of us trusted the RBA. Will it happen, and how high will the RBA's cash rate get? Whether the rate hikes will happen depend upon a few crucial things going right for the economy. The first is the inflation and wage growth must both push above 3% sustainably. At the moment, inflation is looking good, but wages are lagging. Business surveys suggest that wage rises are strengthening. However, two factors may mitigate that. And we're going to look at another article. We'll look at that in another video about firms getting frustrated with wage rises and one way to deal with it. What do you think? Let me know in the comments if you know the way to deal with wage rises in a service-based economy. offshoring it, everyone. However, two factors may mitigate that. The Omicron shock has denuded businesses of labour and may trigger temporary pay rises owing to either shortages or overemployment. As well, the Morrison government is targeting 200,000 foreign workers arriving by June through the reopening of borders, which will suppress wages growth, as it always does. The second reason to doubt if the RBA will get the cash rate off the ground this year is the fact that Australia is lagging global monetary tightening. In China, last year's interest rate rise, which were engineered prudentially, have already hammered its property market and is now exporting a lot of deflation that will arrive in Australia in due course. In the US, prospective Federal Reserve interest rate rises have already caused all kinds of problems for financial markets. The Fed always breaks something in markets, but not usually before it even starts. This cycle looks particularly sensitive given very high leverage and expensive assets. The Federal Reserve may trigger crashes in stocks and credits that land on Australian economic activity and kill inflation off before the RBA needs to pull its own trigger. Assuming that does not happen, how high will the RBA lift the cash rate? Like the US, Australia has very highly valued assets in property, stocks, and bonds owing to historic levels of leverage. This means the Australian economy is more sensitive to interest rates than ever before. It used to be the case that asset prices lagged the economic cycle, but since we financialized everything, that is put debt, not productivity, at the center of economic growth, asset prices now lead the economy, and if they fall, they will drag it down with them. For instance, the RBA's own house price models suggest that only 4 interest rate hikes would crash house prices by 1/4 to 1/3. That's a non-starter, given it would obliterate both economic activity and inflation. So what is the peak interest rate going to be? According to the RBA, the neutral interest rate is 2.5%, but that doesn't sit very well with its house price model, does it? 2.5%. Remember, 3% used to be considered an emergency rate, and we're not talking that long ago, just a few years ago. So even the central bank doesn't have a good grasp on how high interest rates will need to be in today's new normal environment. Things are made even more complicated by the shift to fixed interest mortgages in the COVID cycle. Some $500 billion of mortgages are already going to reset in the next 1 to 3 years from below 2% to nearly 4% as honeymoon periods end. That's a lot of embedded tightening. So don't get spooked by the more hawkish interest rate prognostications, which includes credit markets. If the RBA does lift interest rates, it will likely not get very far before asset prices force it to pause. Indeed, if recent cycles are any guide, the cash rate will barely get off the ground if it rises at all. Such is the way of highly leveraged and financialized economy. And David is the chief strategist at the MB Fund and MB Super, and he's the publisher and editor of Macro Business, if you want to see more of his work, everyone. So what do you think? Potentially 1/5 to 1/3, is that what they were saying? Sorry, 1/4 to 1/3. So up to 30% fall or crash in house prices. Now, what would that actually mean? Let's bring up some. Well, look here. This is the capital cities, guys. And let me just refresh this. This is from SQM. We'll reload the page. What are we looking at? 3 better, 1.1 million. So let's bring out the old calculator. And you can't see that, but I'll do the sums here. We'll do 1.1 times 0.7. You're talking 770,000 for a 3 better. Now let's jump into Sydney and play the same thing. These are asking prices, everyone. So they're what people are asking. So a 3 better in Sydney, 1.6 million. So 1.6 times 70. We're still seeing a $1.12 million 3-bedroom house in Sydney. And let's see, how far back in time do we need to go there? That's a 3-bedroom with 1.5, 1.4, 1.12. There we go, around about here. So we're going all the way back to March 2019. Now, I don't know about you, but was March 2019 housing affordable? Let's have a look at Melbourne, everyone. What are we sitting in at Melbourne? $1 million, $1,080,000. So we'll do 1 million times 0.7, 700 grand. How far do we go back to that, everyone? Hang on. Let's go back here. Come on, back in time. Well, we have to go a bit further back. So you're talking 2015, everyone. 2015 for a three-bedder. So that's a few years of lost revenue or lost capital growth. And good old Brisbane. And you can see the hike we've had, everyone, the recent hike. So 775. So 7.75. Oh, hang on. 775 times 0.7. 540 grand. So how far back would we have to go in Brisbane to reach those prices for a three-bedder? Come on, we'll go boo. Well, come on. Where is it? There. Oh, 2020. December 2019, everyone. Now, this doesn't necessarily mean we're going to have these falls everywhere. And if we have this crash, I think the thing that we really need to be concerned about is government intervention. The government coming to the rescue. Let's have a bit of a talk about that. Now, in many episodes, I've discussed the intervention that the government does. Now, guys, I'm not someone who's advocating for housing always going to the moon. In some ways, it's a pain in the ass of an investment. Think about it. You got to deal with tenants. You got to deal with repairs. You got all these maintenance costs. You've got real estate agents to deal with. Where you stick your money in some shares and you don't need to do anything. You want to sell it, you've got to jump through all these stupid hoops. You've got to hire furniture and do films, and then you've got to pay all the taxes. And now they want to bring in land taxes. So, I mean, sure, people love housing. Is it the smartest investment in the world? A lot of it seems like a pain in the ass, to be honest. That's why I like real estate investment trusts. But we've had our first recession in nearly 30 years. Now, trying to get a quote to do construction work is insane at the moment. Even now, it's still flat out because the government uses the housing sector for intervention and economic stimulus. Both sides of the aisle. What do you think would happen, honestly, if we started to see a sharp decrease in house prices in a year that we have a federal election? Because remember, when government came to the rescue, we had what? 5% mortgage deposits, all you needed, government guaranteed. Then 2%. You had home builder, everyone. That was extended again and again. You had mortgage holidays. You had intervention beyond intervention in the market to prop it up. Can you see it happening again? The question isn't the question is how far down the road will they kick the can, and how far are they willing to put a burden on future generations to keep it all going? What do you reckon? Anyway, thank you for watching, everyone. If you're a fan of the channel, there's a few ways you can support us. Simply liking, sharing, subscribing, commenting, that all helps. You can also support the channel financially by joining us on YouTube or Patreon. You can sign up for SelfWealth or Stake, use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Thanks for watching, guys, and I want to point you to another video I recently did about interest rates in Argentina. Over 40%. Okay, over 40%. And here, we're worried about going to 40%.